Welcome to today's class. We stopped last week with the order of convergence and the complexity of an algorithm and a mathematical problem. We will see at many places in this semester and during the course that some problems can only be solved iteratively, which means that you do not try to find a solution in one step, but you try to find several solutions, and these solutions will get better and better with every iteration you go through. And for this, you will have a sequence of approximate solutions xn. So you start with one solution and you try to improve on this solution in every iteration. And obviously, you would very much like your algorithm to converge. That is, that at some point, the sequence of approximate solutions goes to a solution x star. Ideally, this is also the solution you're looking for. In many cases, you will still have some error. And in many cases, you will have convergence if you go if n goes to infinity, but at some point you will stop and you just say, okay, I am happy with this degree of accuracy, and you will stop the sequence at, say, n time equals 50 or n equals 100. And then at this point you stop and you take the best solution you had in the last iteration. The prerequisite, of course, is that your algorithm converges. And in many cases, you can show that the algorithm does converge. In some cases, you can show that it only converges under certain circumstances. Then you have to check whether these circumstances and whether these prerequisites are given, or whether the iteration sequence might also diverge. Okay. Then, the next important thing we have to look at is the order of convergence, because it might be that you have two algorithms at hand and both are convergent, but one is quicker than the other. Then you will look at the order of convergence. And we say that the algorithm, or a algorithm, is at least of a linear order of convergence if the following holds for a constant c less than 1 and a natural number capital N. If the At this point, let's simply say this, the absolute difference between xn plus 1 and the solution x star is less or equal than c times the absolute difference between xn and x star for n larger than capital N. What does this mean? It simply means that the error between your approximation in the n plus 1 step is smaller than the previous error multiplied by a constant c. So you would expect that with every iteration you go through, your approximation error becomes smaller, but the speed with which this error becomes smaller is linear, more or less. Then the difference to quadratic convergence is the following. You say that the order of convergence is quadratic if there is a constant c again, for which the following holds. Absolute difference between xn plus 1 and x star is less or equal than c times the difference in the previous step squared. And as this is probably very small, if you square it, it becomes even smaller. So the error becomes smaller with every iteration, but the decrease in approximation error is much higher than with linear convergence order. Okay. And of course you can go on and have higher orders of convergence, but usually algorithms will be of linear or quadratic order of convergence. Then you can also distinguish between and differentiate between local and global convergence. Now, for an algorithm, it's quite clear that, for example, if you're looking for a maximal point of this function, and you have an algorithm that is only locally convergent, it might mean that if you start here, it goes up here and it finds this solution. You see that this is a local maximum, but it's not the global maximum. And if an algorithm is able to find the global maximum in any case, regardless of where you start, we call this a globally convergent algorithm procedure. If this is not the case, it is only locally convergent. And later on, we'll look at optimization strategies and optimizers. And usually function optimizers are only locally convergent, especially if they are derivative-based. Because for derivatives, it's quite clear if you use derivative-based algorithms to find the minimum or maximum of a function, it usually works like this. You start at one point, you look into the direction of steepest descent, and you try to find the point from this starting point that looks like the next optimum. And then you usually run into a local optimum. Okay. Small example for this difference between locally and globally convergent algorithms are the Newton iteration. You might have seen this at school or in math studies. It's quite simple. The Newton iteration is an algorithm to find, to solve for a nonlinear equation. Usually it's just, of course, if you have an equation, it's usually equivalent to just take the roots. So solving for a linear or nonlinear equation means you have to find the roots of this equation, because you can just put all the things on the right-hand side on the left-hand side, and then you'll have to find the roots, the zeros of this function. So the Newton iteration is a procedure to find the roots, or the zeros, die Nullstellen in German, of this function. And what you do is, the iteration is given by solution in the n+1 step is given by the previous solution, xn, minus the function value at xn divided by the value of the first derivative at xn. And we try this now with the previous polynomial from one of the previous examples, and we start with x0 equal to 7.5. Now the polynomial P1, you might remember this one was given by 1 minus 36. Now again, remember in the last week we saw this polynomial with the coefficient 36. That should give you, this polynomial should give you the zeros 1, 2, 3, 4, 5, 6, 7, and 8. Now this coefficient is already slightly disturbed, so you will probably get a slight error here. We start with x0 equal to 7.5. In MATLAB, there is a standard procedure to find the first derivative of a polynomial, which is polyder. For polynomial derivative. You simply insert P1, the polynomial, and you get P1 bar. This is the first derivative. x1 then is x0 minus polyval. Again, MATLAB has a standard procedure, a standard function to evaluate a function and to calculate a value of a polynomial, which in this case is polyval. So MATLAB, please give me the value of P1 at x0. And we do the same with the first derivative. So this is in fact xn minus, this is f xn divided by f bar xn. So just the Newton iteration programmed in MATLAB. This is the first step. You can see this is the second result. It's 7.0009. And after 3 iterations, we get 7.0000 and so on. So after just 3 iterations, the Newton iteration finds one of the zeros. And this is probably 7. One would assume that this is one of the zeros of this polynomial. Again, we had no idea into which zero the function and the procedure would run. It could have also gone into 8, which is also a zero, which would also have been a valid solution of this problem. but this is a locally optimal procedure. Okay, so by the way, the Newton iteration here after just 3 iterations gives a good approximation to 1, 0. It's locally convergent, but it's very fast. It has a quadratic order of convergence, and you can see this, that after already just 2 iterations, it's already found 1, 0. And again, remember, this is a polynomial with 8 zeros. So it starts with x to the 8th and so on and so on, and there is no way you could have calculated the zeros of this polynomial by hand. You cannot use any heuristic you might have learned at school, and simply by taking the Newton iteration, calculating the first derivative, which is very simple, you might remember this, and calculating 2 function values. You simply have to plug in the starting value into f and f bar. After just 2 iterations, you get a pretty good approximate solution to one of the zeros of this polynomial. And then how would you calculate the remaining zeros? One intuitive and one clever approach.
Well, you could just vary the starting value of each zero.
Yeah, this would be the intuitive, but maybe not so clever way to do this. You can simply change the starting value and hope that the algorithm runs into a different zero. Yeah.
X minus 7 to point it out from.
Yeah, you simply divide the polynomial by x minus 7. You simply try to cancel out the 0 from the polynomial, and then you know the remaining polynomial has 1 0 less. And then you repeat this after each 0, and finally you should have all the zeros of this polynomial. Okay, so you can see that algorithms might differ when it comes to speed, when it comes to convergence. There are, in fact, many cases where you do know that optimization is globally convergent. And in many cases, you know that several algorithms are horribly non-convergent and also not very fast. Do you know one algorithm that is infamously slow? You've all used this one at school. It's the Gauss algorithm for solving a system of linear equations. Now, if you try to find the inverse of a matrix or the solution to a linear system of equation or a system of linear equations, and you do it by hand on a sheet of paper, this algorithm is infamously slow, and there are much quicker alternatives with which you can solve such a system of linear equations. We'll see that later on. Okay. Now, to give you an idea of what you can do with this in the applied setting, simply take, for example, the ordinary cash flow of a simple bond. Does everyone know what a bond is? A coupon bond? Okay, so you invest usually a notional value of 100 currency units, let's say 100 euros, and if it's an 8% coupon bond, you will get 8, 8, 8, and 8 as the interest payment. And in the last period, you will get your notional back. So you have a cash flow stream of 8, 8, 8, 8, 108. Now, you probably remember from the introduction to finance that for this simple cash flow stream, you can calculate the so-called internal rate of return. You have to compare the interest rates paid on this bond with the relevant interest rate that is paid on the capital market. The risk-free rate usually. It's a risk-free bond. And we want to calculate this present value and also the internal rate of return. Now, we design our own function for this. And I want to show you how you can define your own function in MATLAB. You start by writing function. Then at this point, MATLAB puts function into a blue color because it recognizes that now what follows now is the definition of a function. The function is called myPVvar. It has two input variables, CF and R. You don't have to call these variables later on CF and R. You simply need to know that the first variable you put in parentheses after myPVvar will internally be handled as CF. And the second variable will be called R within this function. The output is this. The function will give as an output one variable that is PV, the present value, we call this. If you want to define a function that gives out different and several variables, you have to write this like this. A, B, C equals myFun and in parentheses x, y, for example. So this would be the definition of a function called myFun that has two input variables, x and y, and that has an output of 3. So you will be given a vector of 3, or better, an array of 3 variables. A, B, C could also be matrices, vectors, but you will get an input of 3 variables, A, B, and C. In some cases we will see this, because in some cases we want to know the result of a calculation, but also the time MATLAB needed for calculating this. In many cases we have 2 output variables, so here we just have 1 variable, which is PV. First of all, in this function, we get the number of periods by putting a percentage sign in front of a line of code. This is a comment, and MATLAB will not execute this line. So this is just a comment line, and I can put anything behind the percentage sign, but this will not be executed. N equals the length of the CF. So I now know, for example, that the cash flow stream has 6 entries. It's a vector with 6 entries. Then next, I have to determine the vector of discount rates. I do this by df, discount factors equal to 1 divided by 1 plus r, the risk-free rate, to the zeros, to the first, square, to the third, and so on. And this here, this is a very interesting line of code. First of all, by putting a semicolon after a line of code in MATLAB, you tell MATLAB not to print out the result of this line. Why would you do this? If you are not interested in the intermediate results, there is no use for MATLAB to print out all the results of all the simple calculations. So you simply put a semicolon at the end of this line of code, and you tell MATLAB not to print out the result of this line of code. Otherwise, your screen will be bombarded with intermediate results, and this will eat up a lot of computation power. Next, again, MATLAB, as the name suggests, is a program that was specifically designed to handle calculations with vectors and matrices, MATLAB, Matrix Laboratory. So in many cases, the operators, for example, divided by, times, etc., these are operators that are, by definition, and by default, defined for matrix operations and vector operations. So, if you, for example, want 2 vectors to be multiplied element-wise, so you don't want the matrix or vector multiplication, but you want the entries of these 2 vectors to be multiplied element-wise, you need to put a small dot before the operator. So in this case, you have vectors, but it's not a vector product, it's not a scalar product, but it's simply the element-wise product of all the entries in these two vectors. Again, remember, if you have these two vectors and you multiply these two vectors, you have the scalar product. So it will be 1 times 3 plus 2 times 4 plus 3 times 5. So this will be a number. But if you want to multiply all these numbers element-wise and you want to get this vector in contrast to a scalar product, you have to write dot star or dot plus or dot minus. And this small dot in front of the arithmetic operator tells MATLAB to calculate or to perform these calculations element-wise, and will not get a proper vector product or scalar product or matrix product. Is this clear? More or less. So again, for example, if you were to insert this in MATLAB, first of all, it will tell you these two vectors do not match in order for a proper scalar product to be calculated. So it will flip the first vector and you will get the scalar product. If I put a small dot in front of this, I will get this as a result. And here we want to calculate all the discount factors, and we want a vector as the output. So I simply say 1 divided by a 1 plus r, and to the 0, first, second, third order, and so on. This here, 0 in parentheses, 0, double point, and n is a vector. It's all the natural numbers from 1, 0, 1, 2, and so on, up until n. So this is the part in which a vector is defined. And if there is at least one vector in this calculation, and we perform all the calculations element-wise, the result will be a vector. And in fact, this will be the vector of discount factors. And then we calculate PV equal to dot CF dF. And in fact, dot, this function dot is a standard function in MATLAB. This will give you the scalar product of two vectors. So this will be x times y. Okay. Now in the next step, we are going to assume that we want to calculate the internal rate of return of this cash flow stream. We assume the notional value is 100, which is standard for bonds. If you see that the bond payments are 8, 8, 8, 8, 108, the internal rate of return is simply given by the net present value on the left-hand side, and you want to calculate the net present value. You set it to 0, and you solve for r, the rate of return. So what do you need? You need to define this cash flow stream as a function of r, and you have to solve for the roots of this function. This is quite simple. We start with the cash flow, minus 100, 8, 8, 8, 8, 108, and then we try to find the roots of this. What do we do? First of all, we take the cash flow vector. Flip LR is a function in MATLAB that flips the vector and Now it's not minus 108, 108, but if you were to print the output, it will simply be 108, 8, minus 100. And then we calculate the roots. So these are the results. These are the roots of this flipped cash flow vector. First of all, why do we need to flip it? Very simple reason. Again, given as a formula, we need to solve this equation. Why do we first need to flip the vector?
It's because MATLAB interprets the first value as
Yeah.
the highest polynomial.
Yes.
And because 108 is in the fifth year,
Yeah.
that's the highest polynomial in that case.
Exactly. I always find this to be very inconvenient in MATLAB, I have to say. I think in R it's different. In MATLAB, again, if we have a vector 1, 2, 3, this means that this is actually 3 times x squared plus 2x plus 1. So if you were to interpret a vector as the coefficient vector of a polynomial, and you had defined it with 1 plus x plus 2 times x squared plus 5 times x to the third, you need to flip it in order for MATLAB to properly digest it as a coefficient vector of a polynomial. So this is why we flip the coefficient, the cash flow stream vector. Now then, this looks different. 1 plus r, etc. Why do we need to solve for the roots of this cash flow stream? It's quite simple, because the roots here, they are not directly the interest rate. They are not the internal rate of return, but you can simply substitute this by z, and then you have minus 100 divided by z to squared, no, z to the 0th power, and plus 8 z, and so on. And these are the discount factors. And quite conveniently, you can see that 4 of the 5 zeros of this function are complex numbers. There is only one real valued solution to the equation given above. So we can simply assume that this is our solution to our problem. And if you calculate, if you reverse engineer this to get the internal rate of return, if you take 0.9259 as a discount factor and you calculate the corresponding interest rate, you will see that it's 8%. This is not a big surprise because, why? If you invest 100, and we assumed that we invest only 100 euros, and you get 108, it's trivial that this the internal rate of return on this cash flow stream is 8%. Now, usually this will not be so simple because in many cases you will not assume this notional to be used in this calculation, but you will probably have a price P that might be 98.59 or something else. So you would use the market price of this bond and then calculate the internal rate of return. Okay. Now, yeah?
Just one question. In the case that there is no fixed income rate, so we have varying cash flows, in that case, we have to count the varying cash flows, and in the step ahead, we have to define that there is not just one output, but then in that case, like 3 or 4 outputs. Does MATLAB?
In case you don't have an internal rate of return, no. First of all, note that this function is this function simply gives you the present value or the net present value of a cash flow stream. So you would insert the interest rate with which you want to compare this. Then, in this case, you would get the more or less the fair price of the bond or of the cash flow stream with this relevant risk-free or relevant interest rate. This is something else. In this case, you assume the present value is 0 and you calculate the internal rate of return. So you don't need an interest rate beforehand to solve for this equation. No? But of course, if you were to take this internal rate of return and if you were to plug it in the myPV_var function, you should get a present value of 0. No? So they should give you the same result. Problem is, this might be quite easy in this scenario that we have 5 roots and 4 of them are complex numbers and 1 is real valued. One might think that this works every time. It does not. And in some cases, one might be tempted to simply take a complex number with an imaginary part that is close to 0. And this is one counterexample that shows you that you have to be careful when dealing with complex numbers in MATLAB. Simply take this very, very trivial example of a polynomial x minus 100 to the third. As you can see, this function has 1 triple 0. It only has the 0 100, but 3 times. If you take this polynomial to MATLAB, if you calculate the roots with roots of v, you can see that it gives you 100 times 1 plus 0.000 times the imaginary part of the complex numbers, the same number with the a negative, almost close to 0 imaginary part, and 1.0000. We again know that this probably is not exactly 1, but close to, given the accuracy of the computer. And one might think, okay, this polynomial has 3 different roots, 2 complex ones and 1 real valued one. No, it does not. It simply is the case here that MATLAB is not able to accurately identify the roots, and it misinterprets one root as a complex number, whereas instead it should be just 100, and it's a triple root. No? So even in these cases, one might say, okay, the imaginary part of this complex number is close to 0, so I simply assume this is a real value number. But again, you will get slight errors, and you might get caught on the wrong foot here. Okay. So this should suffice as a small introduction to MATLAB. You can see that the syntax of MATLAB is quite simple. It's not object oriented. It's quite easy to learn. You should have got a feeling for the very basic problems you encounter when dealing with numerical calculations in a computer. You will always have rounding errors. You will always get small cut-off errors when dealing with sequences, when dealing with numbers that are only given by sequences or infinite sums. And in many cases, even very simple calculations turn out to be quite cumbersome and erroneous in a computer, like the last one. So This should suffice as a small introduction, and let's now turn to portfolio theory and later on systems of linear equations. This will guide us slowly to the field of optimization, because as you can imagine, portfolio theory will ultimately always result in portfolio optimization. And we want to select the stocks and the stock weights by which we can optimize our portfolio return with a given risk. Now, the topic of this second chapter is portfolio theory. I will assume that some of you, at least, have not heard a lecture on capital market theory, on portfolio theory, asset management. That is, I guess, correct. Yeah? Have you ever heard portfolio theory, Markowitz? Okay, no. So that's nice. They should be new to you. The basic setting is as follows. You will probably know that it is always best not to put all your eggs in one basket. If you are an investor and you have $1 million or €1 million to spend, you want to select those securities that give you a high return, but you don't want to take too much risk. So you have a trade-off between risk and return, and it makes sense not to invest all your money in one security. If you were to invest all your money in Facebook, you would probably see that it goes up, it goes down, and you will be exposed to a very high risk. And at some point in time, financial economists realize that investors diversify. They select different stocks, and they don't put all their money in just one stock or one security, but they put their money in many different securities. They have a bank account, they have a risk-free asset, they have many stocks, they might invest in an index, and this is an empirical fact. It's a stylized fact of investment that people diversify. The question now is, why do they diversify, and what is the benefit of diversification? The basic naive diversification would be simply, if I have 1 million euros, I would simply take 10 securities and I put 100,000 euros into each of these 10 securities. This is what we call naive diversification, because it's a naive in the sense that it does not exploit the characteristics of these securities. It might be that there is no diversification at all, because the securities all go up and down in the same manner. So how should we do this? This is the topic of portfolio theory and portfolio optimization. And we want our portfolio composition to be optimal with respect to our personal utility function. And as you might imagine, if we want to optimize something, this will quickly lead us to algorithms from operations research. Does everyone know what operations research is? The field of operations research. It's clear to everyone? Okay.
Could you please explain it?
Operations research is the intersection of more or less optimization from mathematics and business administration and management. In many cases in the US, it's also called management science. So it's everything, all the parts in management at which optimization algorithms and tools from mathematics come into play. Not necessarily statistics, but usually optimization. And it's used especially in logistics, production management, revenue management, scheduling. For example, if you want to make an optimal schedule in a logistics center, and so on. This is operations research or management science. It's quite interesting. Operations research originated from optimization tools with which the Allied forces in the Second World War scheduled and optimized their shipping routes to Europe to optimize and to minimize the danger of the ships to submarine attacks and to maximize the load and the deliveries to Europe, especially to the UK. No? And in many cases, you have scheduling problems where you need to find optimal routes under minimal cost, and this is operations research. Now we start with a small presentation of the portfolio theory by Markowitz, who more or less invented this whole area of research in the 50s. If you want to read a little bit more about this, take the investment and risk management textbook by Albrecht and Maurer, but you can also find it in any other good textbook on investment and asset management. Now we first start by looking at N financial securities. Could be bonds, could be stocks. That is irrelevant to us at this point. We'll usually assume these are 10 or 15 stocks. First of all, we need to calculate the returns on each of these stocks. So we calculate RI, the return on stock or security I, by the price at point 1 minus the price at point 0 divided by the price at time 0. You might also include dividends. You might also leave dividends out. It's up to you how you want to calculate the returns. This is a discrete rate of return. You can also use continuous returns. In that case, you would simply calculate natural logarithm of PT minus the natural logarithm of PT minus 1. Then you would get the continuously compounded log return. But in the end, you will get a percentage number, and you know that, for example, your security I had a return of 5%, 2%, and so on. Okay, and of course the prices need to be known. Now, in this basic model approach, you assume that investors are only concerned about two variables, two risk measures, or two measures of risk and return: expected return and volatility. This means that if R is your random variable of your returns, you're only interested in the expected mean and volatility or variance. This is very simple model setup, but as you can imagine, it also implicitly assumes it does not really assume, but it's closely connected to the assumption of normally distributed returns. Why? A normal distribution or a Gaussian distribution only has two moments that fully define the shape of the distribution: the mean and the variance. You've probably seen this. This is a standard normal distribution with a mean of 0 and a variance and volatility of 1. Now, if we are only looking at the mean and the volatility of the returns, you can see that it's not exactly equivalent to look at normally distributed returns, but it's closely connected to this, because in this case, the whole distribution of the returns is fully determined by the mean and the variance. In financial mathematics, in many cases, you also make stronger assumptions. You assume that your prices and returns follow what we call a Brownian or geometric Brownian motion. We will see this later on in the lecture when it comes to option pricing. But it suffices to say that returns, you simply have an assumption concerning your returns, and we only need to care about the mean and the volatility of the returns. These are strong assumptions. They might not hold in reality, but for this model, it's sufficient to just look at the mean return and the volatility of the returns. Now, it's quite clear you will not be able to maximize expected return and minimize volatility at the same time. So usually we'll look at a situation in which we'll maximize the return with a given risk, or we'll minimize the volatility, but with a fixed expected return. Then, if we have two assets, A and B, they have an expected return of 5% and a volatility of 6 and 7, a investor will choose this? Or will he? Usually, yes. There are some caveats here at work. Who knows about, who of you has ever heard a lecture or anything about risk theory, decision theory, utility functions, risk aversion? Yeah? Okay, at least some of you. The question now is, a rational investor would of course prefer investment A to investment B because it offers the same expected return with a lower risk. Now, the question then is, what happens if we have 5 and 6, 7 and 8? Don't know. Yeah? The alternative B offers you a higher risk, higher rate of return, higher expected return, but also at a higher risk. So you are probably indifferent. The question then is, do investors differ when it comes to this decision? Yes, they do. And this then depends on the utility function. You probably know that if you, in economics, want to know what in the end, at the end of each day, drives the behavior of economic subjects, it's not money, it is utility. You have a utility function, and that is a function usually of, for example, it's consumption and labor and so on, free time, etc. And economic subjects will maximize their utility. That means they derive utility from spending money, consuming things, from working only a fraction of their time, having free time, and there might be other things that give them utility. You will have utility functions, and every one of us has a different utility function. And then, in economics, you usually assume a certain shape for the utility function. And then you can look at lotteries, and you can derive the risk aversion of a subject by looking at the decisions he or she does in certain experiments. Now, you can look at the following. If I give you €3 for sure, or 2 and 4 in a lottery with a 1/2 probability, who of you would choose the €3 for sure, and why? If you were given this choice, €3 or 2 or 4 euros, but in a lottery. No one wants to make a decision.
Yeah, I would choose 3.
So you're risk averse.
I'm
You're risk averse. If someone chooses this lottery, he's risk friendly or risk loving. And if you are indifferent, if you don't care whether you are given 3 or 2, 4, but in a lottery, you're risk neutral. And these 3 types of risk aversion can be differentiated when it comes to the utility functions of an investor. And it's quite simple. For example, the utility function in risk aversion looks like this. This is risk aversion, and this is risk loving. So with increases in risk, your utility is a linear function for risk neutrality. It's a decreasing, should be convex function. No, that is, convex function for risk aversion. or a concave function for risk-loving investors. And this means that, first of all, we have two decision variables, risk and return, mean return and volatility. And later on, we will see that in some cases, it's quite simple to say, okay, if we have the same expected mean, but different risk, this will not be chosen by any investor because it's dominated by the first alternative. But in some cases, if we have, for example, 3 and 4, 5 and 6, we cannot predict which investment an investor would choose. It still depends on the degree of risk aversion. And a risk-loving investor might opt for this, a risk-friendly investor chooses this, and a risk-averse investor chooses this one. Yeah? We would need to optimize the utility function. Okay. Next assumption. We assume that all securities on the markets can be divided as needed. Why? It makes a big difference when it comes to optimization. If, for example, we end up with 1.53 stocks of BMW, this makes it quite simple in optimization and makes life easier in optimization. But if we wanted to buy 1.53 stocks in reality, this would probably not be possible because you can only buy 1 or 2 stocks. So if we were to demand that stocks cannot be divided, this would make the problem a discrete one. And then we would have to resort to functions and algorithms from discrete optimization, and usually these cannot be solved in real time. You can only use heuristics and approximate solutions, but first of all, we'll start with the assumption that all stocks and all securities can be divided, and that we can use methods from just convex and non-convex optimization. And we assume that there are no transaction costs, so we can simply look at the mean and the volatility of the securities. Now, the starting point is the basic idea that Markowitz formulated, that the risk of a portfolio should be less than or equal to the sum of all individual risks. So if, for example, I could lose 5% on stock A and 5% on stock B, it should be the case that the portfolio has a risk of less than or equal than 10%. So you can only lose 5% on the first, and let's say make it in euros. You can only lose 5 euros on stock A and 5 euros on stock B, then your portfolio should have a maximum risk of 10 euros. Ideally, of course, the risk is lower, but the maximum risk should be bounded by 10. So this is the first simple observation. Now, by diversifying, by selecting stocks, and by selecting the weights of the stocks in our portfolio in a very sensible way, we want to exploit the correlation structure between the different stock returns to make the risk go down. And you will see how this works. And we are not primarily interested in a naive diversification. Again, 2 stocks, 50% A, 50% B is naive diversification. It might reduce risk, but you have no clue whether you have fully exploited the correlation structure between the securities and whether you have really found your optimal portfolio. Okay, so blind spreading of your money is not what we intend, but we want to make it in a better way. Okay. Now, Markowitz diversification implies that a useful, sensible combination of single investments can reduce the risk, interpreted as the volatility of the portfolio return, in a way that the risk then is lower than the risk of the sum of the individual investments. And later on, we will see that uncorrelated investments contribute to a diversification of risk. So you can use securities that are not correlated at all, or ideally have a negative correlation. And in this case, we can reduce risk to close to zero. Usually not. You will have to use derivatives for this to work. But you'll see this later on. Now the first idea. If we had perfectly positively correlated assets, this would simply mean that investment A goes up €1 and B also goes up €1. Then with our portfolio, we would get something in between the two investments. But still, we would have all the ups and downs of the individual investments. For perfectly negatively correlated assets, this is quite interesting. We can see that in fact, if the stock A goes down, stock B goes up, and vice versa. So all the changes in the returns are smoothed out, and risk should, in theory, be reduced to zero. And if you do not have perfect correlation, so something in between, a correlation coefficient of 60%, 20%, you will get something in between, and you will still have some ups and downs, but those will be smaller in magnitude than for perfectly correlated assets. Okay. Now let's approach this analytically. We assume we have two stocks, A and B, 1 and 2. The weight of security 1 in the portfolio is given by X, and it's quite clear that X is between 1 and 0, and the weight of stock 2 in the portfolio is simply given by 1 minus X. This is quite simple. We have two stocks, we only need one portfolio weight, and then we use the following notation. First of all, the expected value of the first or second return is mu I. We simply write sigma or sigma squared for the variance or volatility of the first or second return. And we write mu PF for the expected portfolio return, and sigma or sigma squared PF for the volatility and variance of the portfolio return. As we only have two stocks, it suffices to use rho without a sub-index to refer to the correlation coefficient between the stock return 1 and stock return 2. So in the end, we have mu1, mu2, mu PF, the same with the sigma, and rho. So these are the market variables we have. Now let's use them. First of all, the portfolio return is what? Again, remember, the portfolio return is simply a linear function in the returns on the individual investments. So the portfolio return RPF equals X times R1 plus 1 minus X times R2. The expected value or mean is a linear operator, so it's quite simple to calculate mu PF. It's X times mu F, mu1 plus 1 minus X times mu2. And this is the expected return on the portfolio of two stocks, always. The variance or volatility of a linear combination of several random variables should be well known. If you have a function a0 plus a1 times x tilde plus a2 times y as a random variable, you should know that the variance of this linear combination of two random variables is a1 squared times the variance of x plus a2 squared times the variance of y plus this is a1, a2 rho times sigma 1, sigma 2. You might also know this, 2 a1, a2 times the covariance of x and y. Hmm? So it's quite simple to calculate the variance or volatility of the portfolio return. This is simply x squared times the first volatility, variance, plus 1 minus x squared times second volatility plus 2x, 1 minus x, and I think, yeah, there's a 2 missing here. Okay. And you can see that you can immediately calculate the portfolio expected return and the portfolio variance by using the characteristics of the individual stocks. You only need the expected values and the volatilities and the correlation. Now let's look at the set of all possible return risk profiles. So what portfolios and what combinations of risk return are possible with this? We call this the set of the possible portfolios or the set of possible risk return profiles. And we simply see that this is the set of all mu and sigma combinations with mu and sigma squared defined as above. So you can see that some combinations are possible, some combinations are not possible with these two particular stocks. Okay. Now, next, let us look at the set of possible portfolios for selected correlation constellations. Now, if rho, the correlation coefficient, is 1, so we have perfectly correlated, positively correlated random variables, we get the sigma PF, the volatility of the portfolio, is given by the volatility of the second stock plus the difference of the two of the two individual volatilities times x, and the expected return is mu2 plus mu1 minus mu2 times portfolio variance, volatility minus second volatility divided by the difference of the volatilities. And in fact, this set M is a straight line with the risk-return combinations of both single securities as the endpoints. And if you allow x to be any real number, so not just between 1 and 0, this line can be extended beyond the endpoints. And this is what you get. This is stock 1, this is stock 2, and if you only have a correlation of +1, the set of all possible risk-return combinations is this blue line. And equivalently, this is also the set of all possible portfolios. Now, what does it mean to allow x to go beyond 0 or to go beyond 1? What does it mean? Yeah? Leverage. How?
Borrowing money.
If you borrow money and you were to say, for example, 1 is 1.5, this would mean that you would take up money as a loan, you would use leverage, and you would invest more than you currently have into stock A, for example. And what would it mean if x is a negative number? It's quite simple. If x, for example, is 100% and 1 minus x is also 50%, this would mean that you are currently investing 150% of your initial capital into these two stocks, and you need to take up money, you need a loan for this. Okay. Then you can also achieve, for example, this portfolio. But how can you achieve a portfolio here? What does it mean if x is smaller than 0?
Probably sell in short.
Yeah, short sales. This would include a short sale of stock A. Does everyone know what a short sale is? Short selling a stock. It's borrowing a stock from another agent on the capital market selling it immediately, and having to buy back the stock or security at a later point in time. So usually you are buying, then you're the owner, and then you can sell. With a short sale, it's the other way around. You sell what you don't own, you need to borrow it, and then later on you buy it, hopefully at a lower price, and then your position is netted. When it comes to short sales, this is usually the instrument of all Bond villains. If you ever watch a movie and you have a villain that is trying to manipulate stock markets, they usually use short sales. Because they want to drive, it's easier to drive a stock price down than it's possible to drive a stock price upwards. So villains in movies usually use short sales. For example, in Casino Royale, what does the villain try? He tries to blow up a plane, and he first shorts the stocks of the airplane company. Where else? Not so funny example. Same happened with Borussia Dortmund's team bus. The perpetrator and the man who is now being tried for the attack on the Borussia Dortmund team bus, who planted the bombs along the road, he shorted the stocks of Borussia Dortmund, and he intended to blow up the team bus in order to profit from the short sale afterwards, because he was the stock price would have gone down if someone would have been seriously hurt. So these are short sales. Usually they are also used, of course, for sensible means and for legal means. It's just a very interesting way to profit and to invest in decreasing stock prices. But if you want to realize this portfolio here, you need a short sale of stock A. Okay. Now, second special case, we have a correlation of 0. Two perfectly uncorrelated securities. Now, the portfolio volatility is given as follows. We see that you have the portfolio volatility equals 1 plus 2 times x squared minus 2x second variance plus the variance. We then calculate the so-called minimum variance portfolio, or just in short, the MPV. How do we do this? We simply take the first derivative of this equation for the variance, and we set it to 0. And we can see that if you solve for this equation, the portfolio weight of stock A, or stock 1 in the portfolio, with a portfolio that gives you the minimum variance, is second variance divided by the sum of the two variances. Again, x has to be between 0 and 1, and we can get the expected mean and the variance for this MPV. We simply plug in this optimal portfolio weight into our equations, into our definitions for the portfolio return and the portfolio variance, and we see that the result is this. This is the variance of the minimum variance portfolio, and this is interesting because we can see that, first of all, the volatility of the minimum variance portfolio can be written as volatility 1 times volatility 2 divided by the square root of the sum of the variances. This is smaller than sigma 1 times sigma 2 divided by the square root of the variance. Why? Volatilities and variances are always non-negative. And of course, if you leave this out here, the square root should get smaller, and then this inequation holds. And then you can see this is simply the same, and you see that the minimum variance volatility, or the volatility of the minimum variance portfolio, is smaller than sigma 1. And if you change it a little bit, you can see that the minimum variance portfolio's volatility is also smaller than sigma 2. And this is the first simple result. If you were to take the minimum variance portfolio, you can get a variance or a volatility, a risk, that is smaller than each and every individual risk. It doesn't say anything about the expected return, but if you are interested in reducing risk simply by choosing securities in your portfolio, you can reduce risk. That is always possible by choosing the minimum variance portfolio. Okay. So in spite of a correlation of 0, there is still a diversification effect. And this is quite interesting, that even for a correlation of 0, you have a risk diversification. Now, for the special case of rho equal to 0, we calculate all the possible portfolios, the sample space M, and we look for a function expression for the portfolio return. The expected mean of the portfolio return is given by this. X equals to portfolio mean minus mean of the second stock divided by the difference of the two individual means. With X star, so with the minimum variance portfolio, this is given by this. And if we now combine it with the portfolio variance, we get this line, and if we slightly rearrange it, we get this function here, x squared minus times x plus a number. And we can see that, in fact, this is a polynomial. We calculate the roots. We can see that this equation is equal to 0, so we calculate the roots. In this case, because this is a very simple polynomial, the roots can be directly calculated. So we get the roots here. And if we plug this into the definition of the portfolio mean return, and we again plug it into the expected return of the minimum variance portfolio with a lot of calculations, you get the following final result. The portfolio return is given by the return, the expected return on the minimum variance portfolio plus minus this term. So you will always get the return of the minimum variance portfolio plus minus this change given by this last expression. For the special case of the correlation to be 0, you can see the graph of the sample space is the right arm of a hyperbole, and I think it's best to view it here. We start with stocks 1 and 2. For correlation of +1, we get a line. If we now start to increase correlation, it will go up. No, we start with correlation of 1. We get a line, and if we decrease it, we get hyperboles. For example, this. And it will go on until what happens? At some point, we get a triangular structure. And this is the special case of correlation equal to -1. In this case, again, we can solve for the variance of the portfolio. We can look for the minimum variance portfolio, and you can see that for a correlation of -1, the minimum variance portfolio has a variance of 0. So in fact, the minimum variance portfolio is risk-free. And portfolio risk can be completely diversified. And this is this case. For a perfect negative correlation between the two assets, we can achieve any portfolio on these two lines. So you can see that we have two extreme cases. The one is +1 correlation, The second one is -1 correlation. And if correlation is somewhere in between, you will probably get these lines. And you can realize any portfolio on these lines. And if you assume that X can go beyond 1 or 0, you can also achieve different portfolios. But again, for example, you could choose this combination, or you can also choose this combination. And the interesting question is now, which portfolios should we look at? At which portfolios should we look at? Quite simple. If we were to compare these two portfolios, you would see that they have the same risk, but A has a higher return than B, so we should not consider B. This means that in all of these cases, regardless of whether we have these straight lines or whether we have a polynomial, we only consider the upper part, because all the portfolios on the lower part are dominated by portfolios on the upper part of this set of all possibilities and of all possible portfolios. And this is why usually if you hear of Markowitz portfolio theory, you start with this point and you will see something like this. And this is always the minimum variance portfolio, because you have sigma on the x-axis and expected return on the y-axis. You start at some point, you have the minimum variance portfolio, and then you only consider what has been famously has become famous as the eggshell and the half eggshell in portfolio theory. You only look at this upper part of the set of possible portfolios, because you know, yes, you can also construct portfolios here, but these portfolios are all dominated by portfolios on the upper part. And then, if you know this, the question then becomes, which portfolio should we choose? Again, in many special cases, if you don't have a risk-free rate, two investors with two different utility functions will choose their ideally optimal and utility maximizing portfolio. We will see that as soon as a risk-free rate comes into play, all investors will choose the same portfolio. But still, we need to find out which portfolios they choose. Okay. I think I've run out of time now. Do you have any questions concerning this first introduction to portfolio theory? Please remember, it's all about risk and return, expected values and volatilities of the portfolio returns and the individual stock returns. And you need to know when a portfolio is dominated, when it is not efficient. We only look at efficient portfolios, and we usually start with the minimum variance portfolio, because as I've said here, this is usually the starting point for the set of possible portfolios. Okay. So if you have no questions, thank you for your attention and see you next time.